Yeah, welcome everyone who's joining now. If you are hopping in, we're gonna get started here in a couple of minutes, but go ahead and throw in the chat where you're located and where you invest. Scott just says that he's invested Pacific Northwest, Bourbon Trail, OBX. Where are you at in the OBX, Scott? Super curious. I actually grew up in that area and I'm headed down there in 2 weeks. So I love that space. Yeah, welcome everyone else who's hopping on. South Island, Frisco, nice. Yeah, the Outer Banks is fantastic. It's definitely underrated and not as popular, but I think that might be good for the current investors down there right now. All right, welcome everyone who's hopping on right here at the top of the hour. We've got Ted Lanzaro, CPA, up here to answer all sorts of tax questions and tech strategy for investors. And so we'll get started here in probably just 1 or 2 more minutes once the people who are joining right at the top of the hour are jumping in. But if you just joined, go ahead and drop into the comments in the chat, like where you're located and where you invest at. Would love to get some of that information. We've got a couple folks over in Branson and then investing Bourbon Trail, Pacific Northwest. Yeah, would love to see where everyone else is at. I'm based in Asheville in Savvy's hub office in North Carolina. Ted is over in Connecticut, so we got folks from all over. I see Jeff says he's investing in Scottsdale, Sedona, Palm Springs. Yeah, all of those are fantastic. I know that Mike, who's our agent over in Sedona, is really loving what he's seeing there in terms of appreciation and cash flow. And Palm Springs is just gorgeous. I got to go to a friend's wedding out there last summer, which was a little bit warm, but also still lovely. Awesome. Well, thanks everyone for hopping in. Looks like we've got a couple more people trickling in, but I'll go ahead and introduce myself and hand everything over to Ted. But my name is Scott. I am with Savvy Realty. I am our director of client success. So my department, our whole job is to get you connected to the realtors and the resources you need across the whole country. My team, loves to analyze markets and hear about what your buy box is and get you connected to the markets that are going to be great for your next short-term rental. And then if you ever have any needs in terms of vendors to connect with, or needing to get connected with a great CPA like Ted, we can do all those sorts of introductions too. So that's what we do. And it's been great getting to meet Ted recently, and we're really excited to kind of dive in and hear a little bit more about some of his tax strategy, especially that the new bill is kind of shaking everything up. And so I'll go ahead and hand it over to you, Ted, but thanks so much for hopping on. And everyone, feel free to drop questions into the comments while we're chatting just throughout it. We'll be happy to answer them and get going there. But thanks a lot, Ted.
Well, hey, Scott, thank you so much for putting this together. And I'm so happy to be here. And you can see the screen, right? You can see the presentation screen?
Yep.
Investing. Let's see. So there's my 35 years. I've got a book. It's called Year-Round Tax Planning for Real Estate Investors. It was released last December, and now I'm in the process of updating it for all of the new tax laws. So that's exciting. I'm getting that kind of all the one big beautiful bill tax stuff added into it, and we'll re-release it in a few weeks, actually. Right? Give a little time to get. So what are we going to talk about today? We're going to talk about tax planning, and specifically proactive tax planning, and how advantageous that can be. And we're going to talk about it in terms of short-term rentals today, because I know that's a real big topic of interest amongst high-income individuals looking to cut their taxes. So we're going to talk about why tax strategies need to be tailored to the individual person. We're going to talk about being proactive and granular. We're going to be talking about why high-income W-2 wage earners should be real estate investors, even if they can't qualify as real estate professionals. We're going to talk about why short-term rentals are so important, using Schedule C for short-term rentals versus Schedule E. We're going to talk about cost segregation, and we're going to have a quick chat about entity structure, and then I'll take some questions. So it starts with everybody's different, right? There's no one size fits all tax strategy. We tailor tax strategies to people's individual situations. That's literally what I do all day, is look at people's situations and say, hey, this will work for you, right? And one of the things that we've found for people who cannot qualify as a real estate professional, meaning that long-term rentals, while they're a great wealth building tool, they're not necessarily a great tax reduction tool for people who can't qualify as real estate professionals. So if you're a W-2 employee or you're a business owner outside of the real estate space, short-term rentals are basically your solution to being both investing in real estate for wealth creation, but also for the tax benefits, right? So when we talk about being proactive, what I'm really talking about is talking to your CPA about your tax situation during the year, right? So I'm having ongoing conversations with all of my clients during the year about their 2025 taxes. We're talking about, well, where's your income this year? And it's like I have people who have sold properties. Well, now they know what strategies they need to put in place or how much replacement real estate they need to buy, right? If you have a capital gain of $1 million, and we can tell you, hey, you need to go out and buy $2.5 million worth of property to replace that using bonus depreciation. Let's say you didn't do a 1031 exchange, but you're going to go out and buy some short-term rentals to take the bonus depreciation to offset that gain, right? So being proactive and talking to your CPA during the year is just so important, and it's really the way to maximize your tax savings. And I always tell my clients, I want to know before you buy, before you sell, or before you renovate a property, because that's going to be the key areas where we're going to be able to make a real difference. And like with short-term rentals, it's also, before you outfit a property, like you buy it, and now you've got to put, what do you put in furniture, equipment, all of the various, things, pots and pans and sheets and towels and whatnot that people put into the houses, how to maximize the deductions on that. And being granular means really diving deep into transactions to be able to get the best tax benefits for them. So it might be taking a deep dive on repairs. Like if you were to do renovations to a property, I've got a client who just bought a short-term rental, but he's got to do a bunch of work to get the house ready so that people would want to rent it, right? So now we're taking a look at his scope of work for his renovation, and we're getting very granular about how he does those things, because we want to be able to maximize the benefits of his cost segregation study when he ends up doing it. When he's done with the renovation, we're going to do a cost segregation study. So we want to be able to work with him during the construction to make sure that he's getting the best advantages when it comes time for the study. So that's kind of an example of being granular. It's not an approach a lot of CPAs would take, but it's because it takes a lot of time, but it also has a ton of benefits. So why should high-income W-2 people and high-income business owners be real estate investors? Well, same reason everybody should be a real estate investor. You're going to do it for the cash flow, you're going to do it for the appreciation, and you're going to do it for the tax benefits. And typically, the higher your income is, if you don't qualify as a real estate professional, meaning you're not a real estate broker, you're not a developer, you don't spend more than half of your time in a real estate related business, um, you're typically kind of locked out of the tax benefits that a lot of real estate professionals are able to take on their long-term rentals, right? So for high income W-2 people and business owners, short-term rentals are really the way to go because they allow you to move, and we'll talk a little bit about this, but they allow you to take tax benefits without qualifying as a real estate professional. It's so-called short-term rental loophole. But it's not really a loophole. It's actually just a section of the IRS tax code that differentiates short-term rentals as trades or businesses as opposed to passive rental properties. So why would you want to use short-term rentals? Well, if you don't qualify as a real estate professional, they are the real estate investment of choice because you can use the losses to offset ordinary income like W-2 wages, if assuming that you qualify the short-term rentals in one of the ways that we're going to talk about in a little bit. You don't have to be a real estate professional. That's the big catch. That's the loophole. You can use the 100% bonus depreciation against your W-2 income under the new tax laws that just passed, the One Big Beautiful Act. And the way you do that is instead of reporting the income on Schedule E as rental income, you report it on Schedule C as business income. All right, and I'll show you how to qualify for that. So there's 6 rules essentially that allow you to use Schedule C instead of Schedule E for your short-term rentals. And this is like, you can see it's IRS Section 469. So people sometimes ask me, well, what code section is that? Well, there you go. It's Section 469. Your short-term rentals can be reported on Schedule C as a business if you're doing one of these 6 things, right? The easiest one typically to qualify for is the 7 days or less average rental, right? And the reason that is if you're doing short-term rentals, like a lot of people, when they do short-term rentals, they'll do them week to week, right? And so typically on a week-to-week rental, you may go in on a Saturday afternoon, but you have to leave the following Saturday morning. And there's a spread there, like a 5 or 6 hour spread there where, typically a cleaning company will come in and get it ready for the next set of tenants, right? The IRS counts that as a 6.5 day week. So if you were only to do week-to-week rentals, just as an example, you would keep your average stay below 7 days or less. And basically all of the tracking on the Airbnb and VRBO, whatever, they give you the reports on whether or not what your average stay is, right? Now, there's a couple of other ways to do that. Like, for example, if you're providing services like a bed and breakfast would, like you're providing breakfast, or maybe you have a very high-end rental where you're providing a private chef and transportation and events. You've coordinated some things for them to do while they're there. I have a guy who has a house on a lake, and he has a captain that takes the people out on a boat as part of the rental, right? So if you're providing extra personalized services, then or hotel-like services, then you can actually have a longer than 7 day rental and still qualify as a business, right? So there's 6 of these, but the 2 big ones are you're either providing services or you're keeping the average stay under 7 days. What the IRS says, if you're doing any of these 6 things, then you can call this a business and you can report the income and deductions on Schedule C, right? Now, what does that do for you? Well, that now allows you to put the depreciation schedule on Schedule C also, right? And take the bonus depreciation on Schedule C, for which there are no passive loss limitations, right? So now this comes directly off of your W-2 or business income as a tax deduction. And I'm going to show you how that kind of works in just a minute with a few case studies. The other caveat to this is that you have to materially participate in the rental, right? So if you're going to avoid the passive activity rules, then you need to materially participate in the operations of your short-term rental. But you only need to meet one of these 7 criteria, right? So I love the one that says you do everything yourself, right? Because then there's not really an hourly requirement. If you're doing everything, right? Or you spend 500 hours during the year, right? And you can combine that 500 hours. It could be you and your spouse spending that 500 hours. So it's not, you don't have to do it personally. Or you spend 100 plus hours and nobody else does more time than you, right? So there's a whole list of these criterias, right? Or you're doing the personal services. So if you're the person who's literally running the bed and breakfast, right? Then that would qualify you, right? So all of these things qualify you for material participation. Now, what I tell people is I like my clients to keep time logs, right? Tracking is really, really key. And not only is the tracking key, but keeping evidence of the tracking. So I tell people, keep your emails in a separate little file in your Outlook or whatever, anything related to your short-term rental. When you go out and look at short-term rentals with realtors, keep the realtor's card or keep the realtor's information. Go out and keep the pictures of the rentals if you took pictures when you went to see them. Document everything you did during that time. Why? It's all the stuff that if you ever were to get audited, and the chance of you getting audited is probably not great, but if you ever were getting to get audited, you go into the IRS's office with all of your documentation, you're probably walking out of there, without an issue. You walk in there with no documentation, you probably are leaving cutting a check, right? So that's kind of like you want to have all of this documentation. The only time, and I've been doing this 35 years, I've been involved in 3 tax audits in 35 years. I remember one was a real estate professional audit, and my client went into the office here in New Haven, Connecticut, and with a book about this thick of all of their evidence, and the agent took one look at the book, kind of flipped through it, said, "Okay, we were out of there in 3 minutes." Right? No problem. Why? Because they had the documents, they had the log, and they had a big book of stuff, and the agent wasn't going to sit there and try to nitpick the information. They just wanted to know that the person was keeping track. So tracking your time on your short-term rentals is going to be very, very crucial. Right? So let's talk a little bit about how we create these losses. So when we talk about taking losses against your W-2 income, we're not actually talking about you losing money, right? So it's not like taking losses in the stock market or something. It's basically you're going to buy this property and then you're going to depreciate it. And that depreciation is actually a non-cash transaction, right? So you get to deduct the cost basis of the property over the useful life of the property. And then the question that becomes is how do we break the component pieces of the property up so that you get the maximum depreciation benefit? And that's what a cost segregation study essentially does. A cost segregation study is nothing more than an engineer and an appraiser walking through a house, identifying various components, and then assigning a value to those components. So there's basically 4 kinds of components in a house, right? And the first one is the 5-year component, which is tangible personal property. And an easy way to think of tangible personal property is it's anything you can unplug, unscrew, somehow detach, and walk out of the house with, right? So it's probably pretty much everything in the kitchen and everything in the bathrooms. and all of the decorative lighting, all of the stuff in the closets as far as like shelving and the like. And then there's other stuff in the house, but those are the primary components, right? Kitchen cabinets, vanities, countertops, sinks, toilets, whatever, tubs, right? And typically, tangible personal property in a nice house, depending on the finishes or whatever, will run typically about 15 plus percent of the cost of the house, right? And then there's land improvements. Land improvements are 15-year assets. They're also, so 5-year tangible personal property is subject to bonus depreciation. 15-year land improvements are also subject to bonus depreciation. So the land improvements are things like the driveway, fencing, sidewalks, landscaping, trees, curbs, anything that's on the outside of the house, right? And those are typically going to run somewhere between 5 to 8%. If you buy a house on a lake and you have a dock, the dock is considered a land improvement, right? That would be a big one, right? Why? Docks are expensive. If it's got a beautiful patio, that'd be a land improvement, right? And that's a good one. Why? They're expensive. Pools, right? Same thing, expensive, right? So you can typically on a nice short-term rental get quite a bit of dollars out of the land improvements, right? And then you're going to depreciate the building over 27 and a half years, and you're going to allocate some of the cost to the land, right? But typically, you're going to end up getting about 25% of the purchase price of the house is going to be allocated into one of those two categories, 5 or 15-year assets, and that's going to allow you to take 100% bonus depreciation on literally about a quarter of the purchase price of the house. So on $1 million house, you should be thinking $250,000 to $300,000 worth of items subject to cost segregation. Okay? And you get the best results with cost segregation when you take the cost segregation deduction, the depreciation deduction, and apply it against the highest income. Why? Because if I'm taking, let's say I make $1 million a year, and so now I'm in the 37% federal tax bracket. So when I go and I apply $100,000 worth of cost segregation, I've reduced my income from $1 million down to $900,000 as an example. I've just saved $37,000. Why? Because I cut the top of my bracket off, right? I'm deducting at the highest possible bracket. So to the extent that you can do that, it's a real win, because coming back on the depreciation when you go to recapture it, if you're in a lower bracket at that time, so there's some recapture that's recaptured at 25%, and there's some other things that are recaptured at your ordinary income rate. But the idea is that the cost segregation study creates both a time value of money. I'm deferring the taxes for however long I hold the short-term rental. So if I hold it for 10 years, I'm deferring my taxes for 10 years. If I hold it for 20 years, if I never sell it, I've deferred it permanently, right? Okay. And if I do end up selling it, I want to sell it in a year where my income was lower than the year I bought it in. Why? Because I'm creating like an arbitrage. I'm deducting at 37% and I'm recapturing at 25%. So I've got a 12% spread, say, just as an example, on the whole period. I've deferred for a period of time, and I've gotten a different rate, a lower rate that I recaptured at than the rate I deducted at. And if you do that, it's a win. It's a huge win and makes a big difference. So one of the things that I see people making mistakes with is just not maximizing and safeguarding their tax deductions. So before we get into some case studies, we'll talk about just having, for your short-term rentals, always have a good accounting system, keep your receipts, document your repairs, issue 1099s to your subcontractors. Don't miss any administrative expenses. And I'll send you guys a list that Scott can send out to everybody of all the different administrative expenses that like literally 90% of my tax clients don't think of before I send them the list. And then I usually get a list back with all these various expenses that they can deduct. So let's talk about some case studies here, right? So these are actually this is actually a client that I'm working with, right? She's an attorney. She makes about $900,000 a year. She just bought a property, right? We're going to cost segregate it. She's going to meet the she's going to meet all the rules, the under 7-day rule and the 100-hour rule, right? We just got the estimate back on the tax engineering, right? She's going to get $185,000 tax deduction. So what does that mean? She's going to be able to reduce her taxable income from $900,000 a year down to $715,000 a year for the year. And in her tax bracket, that's going to save her $68,000, right? So she's in the 30-something% tax bracket. That's an amazing result, right? And she's probably going to make money on the Airbnb. Why? Because these things throw off a lot of cash, right? So you're getting both the cash flow and this amazing tax benefit, right? So it's actually really cool. So let me give you another example. This is another client that I'm working with. He makes about $600,000 a year. He just bought a beach home, right? But he's actually doing some a little bit different, right? He's got some services built into his property, right? He went on a trip and they had a private chef at this place and he's like, oh my God, he's like, he just thought that was the best experience. So now he's using that idea into one of his properties, right? So he's managing it. He's providing services, housekeeping, private chef. I've got another client I mentioned that does the boat captain thing and takes people like skiing and fishing and stuff on the lake. So he's going to meet the 100-hour requirement. He's going to be qualified by doing some hotel-like services. He got a cost segregation back $300,000 in his bracket. That's going to save him $110,000. Reduces income from 600 down to 600 down to 300. That's a huge one, and he's going to save $110,000 as a result. You can see how, like, you can literally, like, this is a big hit. If he bought 2 of these, he'd have no income, right? So that would be even cooler, right? So you literally can wipe out your income. So here's just a little plan. I'll take some questions, but here's like sort of an action plan, right? So what I've one of the reasons that I love Savvy as a short-term rental agents helping my clients is because I'm able to send them over there, and my clients who don't, my clients, if I told them to go buy short-term rentals, would be like, oh yeah, great idea, Ted, great idea. But then they'd start looking into it, and I've had this happen before. They start looking into it, and it's a little confusing sometimes, and they're not using any resources. What happens? They get analysis paralysis, and they don't end up buying anything because they don't want to make a mistake. By sending clients over to Savvy, they're getting educated on the markets, right? They're learning about the different markets. They're learning about what's available. They're learning about what properties they can afford to buy. They're learning about what to expect as far as dollars in, what the legislative environment is, all of these things that would stop people potentially by getting confused, would give them analysis paralysis. So this is solving this problem for my clients. So let's say you go out, Savvy finds you a nice property and you buy it. Now we sit down and we talk about which one of the 6 tests you're gonna be able to use. We set you up with a log so you can log your hours. We're going to set you up with a cost segregation study so you'll be able to take bonus depreciation in year one. Now you use the losses to offset your income. Rinse and repeat. Do it once a year, right? The clients that I have that have done this well, and this is back in the past also when there was bonus depreciation from 2018 to 2022. Some of them were buying a house every year, right? And some of them have really nice portfolios now. I have one client that owns about 6 houses in the Poconos, and I'm astounded when I do her taxes every year. I'm astounded at how much money these properties actually make, right? I mean, like she does really, really well on that, right? And then we use the cost segregation to wipe out the rental income in her case. Right? But this is a really, really good way to not only save money on your taxes, but to build long-term wealth, right? So that's it. I think we covered it. I'll take any questions anybody has.
Yeah, we got some questions in the chat, Ted. One of them was, can you do more than one cost seg study on a property? For example, I purchased a STR rental property, did some basic renovations, did a cost seg study. Now, 3 years later, I'm looking to do more renovations, redo the backyard and pool, kind of a second cost seg study on the new renovation expenses.
Yes, you can. Yeah, and if it's a material amount, you definitely want to do that for sure. Especially now with the 100% bonus depreciation.
Awesome. Let's see. Another one was, can you give an example? It looks like they're making about 300,000 W-2. What happens in year 1, 2, 3 after taking a new property in terms of tax savings? They said that they have a STR property manager, but we're doing 51% of the work. Is that good enough for material participation, and do a focus on cash flow versus tax benefits? Those were some of the questions from them.
Yeah, can we do those one at a time?
Yeah, sorry. The first one was what happens in year 1, 2, and 3 after taking a new property in terms of tax savings.
Okay. Right. So in year 1, you're going to get this big tax savings, right? You're going to get a big bump off of your income. In year 2, you still have to remember that you still have depreciation on this property, right? Because you only took bonus depreciation on about 25% of the cost basis. So you still have 75%. Well, you've got a land allocation, but so you still have about 60% of the cost to depreciate. Typically in years 2 and 3, what you're going to find is that you're going to end up with some net rental income, right? That's a good thing because the net rental income is still going to be offset by the depreciation. So you're going to have more cash flow than you have net rental income. So you're going to still have deferred cash flow. So let's just say, as an example, the second year 2, you actually make $100,000 and you depreciate $40,000. Well, so now you're going to pay tax on 60, but you're going to have 100 in your pocket. Does that make sense? Right? So that's going to be year 2 and 3, unless you go out and buy another property in the following year, and then you use the cost segregation study on the second property to offset the income on the first property and some of your W-2 income, and you just keep recycling that. And at some point, you've created a really nice portfolio for yourself.
Awesome. Go ahead and move to your next slide, Ted, just because I know there is a QR code for anyone who maybe has to hop off now but wants to get connected with you.
I forgot
yes,
this slide.
we've got more questions, but Scott Reese did say, are you licensed to serve clients in other states? And so I think he can connect with you here, and I'm guessing the answer to that is yes.
Yeah, we run a national boutique tax consulting and tax preparation firm. You don't have to be licensed in other states to do business with the client, to do tax services. So yeah, I work with investors all over the country.
Awesome. One of the other questions was, how much does a cost segregation study typically cost?
On a short-term rental, probably somewhere in the neighborhood of $2,500 to $4,000 for a good sized house. If it's a smaller property, sometimes about $2,000. You can get them done cheaper. I have about four companies that I work with that I've worked with uh, from anywhere from I've worked with one for 20 plus years. Some of the others I've worked with for 10 years. Um, they typically what we do is we go out and we get the fee quotes and the benefit analysis for clients, and then we go through the various quotes and we pick the best one, essentially. Because it's not always about cost. It could be about how much the benefit. That's a real big point. So if you're looking at two cost seg quotes, and one's 2,000, one's 4,000, but the depreciation that they're estimating is $150,000 higher, you always go with the higher priced one because if their benefit analysis is higher, you're getting more tax benefit than you are paying in fees. That's really important because there's two kinds of studies. There's a desktop study, meaning they did it based on pictures you provided them. And then there's an actual site visit. You're going to pay more for a site visit, but you're going to get a far higher benefit analysis and subsequent reclassification from a site visit. That's really important.
Awesome. Everyone, keep dropping your questions in the comments, and we'll keep getting to them. But the next one was, does your entity structure matter? Sole proprietorship versus LLC, for example, assuming that you meet all the participation requirements.
Yeah, I mean, I like LLCs. I would not have a sole proprietorship. I like LLCs because they provide protection against your protection from the rental property against your other assets, right? So I just from an asset protection standpoint, I like the use of an LLC. I would advise people to do that, especially if you have, high income and high net worth. I mean, you want to keep those things separate. There are risks of having people in and out. If you did a week to week and you were full every week, you'd have 52 families running through your property a year, right? Somebody's going to get hurt. Somebody's going to fall down or something, right? So having good insurance, managing the property well, and having an LLC are the three big roadblocks you can put in the way of potential litigation.
Perfect. One of the other questions was about time logs and said, is it okay to log real time, but not to save all receipts like gas, travel, and furniture?
I mean, I would do the best I could. I'm not telling you have to go bananas saving receipts. I would do the best. I would do the best I could. I would definitely keep the time log, and I'd keep receipts for anything that cost me more than $500. That's for sure.
Good. Perfect. And Christian, who was asking the question about the LLC versus sole proprietorship, was just wanting to make sure that there's not a difference in deductions, because that's what he was more so curious about deductions than asset protection, and if there was any difference there.
No difference in deductions. You get the deductions whether you're a sole proprietorship or an LLC.
Awesome. Another question: S corp versus LLC.
I mean, if you're in a situation where you're reporting where you've got a lot of income, an S corp could make it. That would be, I always say everybody's different. I'd have to look at the situation, what you're actually doing. But if you're providing services and you're charging separately for those services, an S corp could really make a difference. Yeah.
Perfect. Another one from Jeff. Is there a drawback to what you can depreciate on a cost seg study if you are purchasing a property that had previously been a STR? He said that when he'd done a previous cost seg study, the person doing the study wanted to know if it was previously a STR/rental property.
I don't know why they would ask that question. Honestly. And don't forget, with your short-term rentals, not only are you cost segregating the house, but you're automatically getting 7-year treatment on your furniture, right? 5-year treatment on any technology you put into it, right? So all the things that you buy and put in the house, you don't have to cost segregate those. Those are automatically 5 and 7 year assets.
Awesome. I think that's all the questions currently, but I have found that if we ask for a couple more, sometimes they trickle in. So Ted and I will keep hanging out, and if any more questions come in, we'll keep getting to those. But I did want to say thank you, Ted, for hopping on and telling us just about some of these strategies. And if y'all want to ask any questions, you've got Ted's contact information down there on the slide. Also, that QR code should link over to him. And if you're someone who is wanting to buy by the end of the year, feel free to reach out to me and my team. You can reach out to me at scott@savvy.realty. We can hop on a phone, talk about your buy box. Make sure you tell Ted before you buy that you're going to be buying, because your CPA likes to know that. And but then me and my team can get you connected with some agents in those markets and can get you started. And now is a great time to start looking if you're trying to get something by the end of the year, because if you wait till September or October, you're going to end up bidding a lot more with other investors who are in the same boat and waited. All right, let's see. Christian said, "How do we get the admin list?" Ted mentioned. You mentioned the admin list of expenses. I think Ted.
I'm going to send Scott. I'm going to send you, Scott, that list, and
Perfect.
then maybe have Lou send it out to everybody.
Mm-hmm. All right, that sounds great. Another question was, is there any special verbiage you can recommend the property manager to put in the contract so I can get credit for material participation?
So when you have a property, don't forget. So this is gray. Let me start with that. Okay, right? This is not black and white, right? When you have a property manager, okay, I look at it like you're still the asset manager, right? Because you've got to manage the property manager. It's still your property, right? So your hours come from the conversations you're having with your property manager, reviewing the reports, looking for new rentals, going over the numbers, making sure you're maximizing, making sure the shopping you do to buy stuff, all of the various things. So I would that's why I tell you to keep a time log, right? Because you can have a manager and still materially participate if you do it right, right? Because you are the asset manager and the owner, right? So that's the position I take. Now, is that going to fly with every IRS agent you ever meet? No, right? It is gray, but it's going to fly with 90% of them, and the chance of you getting looked at are slim to none at this point. So.
Awesome. Let's see, another one about timing for placing in service. Can you talk a little about timing on cost study and when the property is placed in service? Doesn't matter when it's placed in service.
I mean, in theory, you could place the property in service on December 31st. What I would want you to do at that point, though, is have somebody in there having a New Year's Eve party, right? So that you could say, hey, it was rented this year, right? Now, how did I get my 100 hours in? That's a good one, right? But you might be able to qualify for one of the other. Hey, I did all of it, right? I bought the house. I did everything. I furnished it. I did everything. I didn't have a property manager. So there's a whole list of the criterias. So we could probably, that's a good seed. And this is the kind of question, just as an example, that if you were going to do this, right, and you were going to get tight to the deadline, like tight to the year end deadline, this is a conversation we'd be having like in November when you put the property under contract, right? As part of your planning that we would do, right? How do I make sure I get this advantage? What do I need to do? Right. And we would figure something out. We'll look at all the angles.
Awesome. Another question. If you have about 400,000 to spend on a STR, it seems like you'd do better with a condo versus a single family home because there's no land associated with purchase price. So would you get a better bang for your buck with the condo in terms of cost seg?
So if you have $400,000 to spend, is that the question?
Yeah, if you have 400,000 to spend on STR, it seems like you'd be do better to do a condo versus single family home. That's what
I
they're
mean,
curious
look,
about.
if I have 400,000 to spend, I can buy. So there's a difference between I'm going to buy a $400,000 property versus I have $400,000 to invest, because $400,000 to invest means you could probably buy up to 1.6, right? Because you put 400 down and you leverage the other 1.2, right? With a loan. But if I only had 400,000 to spend in total, I would definitely I would not go immediately to condo. I would look at the house purchase price. Okay, that clarifies it. So on a purchase price, right? So I have a $400,000 purchase price. House, I would look at both. I would look at the houses that are in my price range, and I would look at condos, and I'd look at the markets, right? And here's what I would tell you about condos. You have to be very, very, very careful with condominiums. You better have read the condominium documents. You better know how much reserves they have, right? Because condos can, by you buy a property, sell a property, or renovate a property. I think that's really, really
Yeah,
super important.
we're super thankful to have you on, Ted. Like Ted mentioned, he'll send me that admin list, and I will go ahead and email that out to everyone who is been here on this webinar, and we'll also email you a copy of this video if you want to re-watch it. If you are going to be buying before the end of 2025, reach out to us at Savvy, and we'll get you connected to the right market, to the right agent that'll fit what you're looking for. We've got lots of thank yous in the chat, Ted. So thanks for hopping on.
Thank you. It's my pleasure, and I'm glad everybody was able to get on. Thank you for taking the time to get on today.
Awesome. Thanks, guys. Everyone have a good rest of your week, and hopefully we'll be seeing everyone again soon.